All right, guys, welcome back. We're going to be going over unmitigated wicks, right? So a unmitigated wick is very similar to a rejection block. It's a long wick with a small body or a large body at times, right? It's simply just a wick that was not mitigated. That's all it is, right? And you can see it as an order block. You can see it as a rejection block. So for example, let me make that straight. So for example, we have order block and then we have a wick, right? And let's say liquidity is built up. Let's say Asia liquidity is being built up right here, right? And all we have above this is this 1 hour order block wick, okay? So price taps into the wick and then it falls. That's the unmitigated wick, right? Again, it depends where the liquidity is being built. So obviously, if the liquidity is being built, let's say above the open, then we're going to take the risk here. If it's being built right here above this unmitigated wick, then we're going to take the risk here. Does that make sense? All right. Same thing with a rejection block. Depending on where liquidity is being built, let's say Asia liquidity is being built up here, then we're going to take the risk on the open. Right? If it's being built just above the unmitigated wick, then we're going to take the risk on the open. Now, don't forget about the 50% of the wick. All right. So if this happens, taps to open, fails to break this high, failure swing, then this gives it a reason price to come down lower. It's feeding liquidity into that POI. All right. In other words, the 50% of the wick. And then it will go. All right. Same thing, vice versa. All right. So that is a unmitigated wick. Simple as that. That's it for now. On to the next one.